welcome on behalf of James and I, and indeed the wider Norcros team. I'm going to take you through a couple of slides before I hand over to James, who will take you through the financial highlights. But before we do that, I think it's important that we just focus on three key takeaways from this presentation. The first is, as we continue to implement the strategy that was put out at our Capital Markets Day a year ago, we continue to make market share gains, and organic growth is always a really good indicator of a company's health, and we're really comfortable with how we're doing there. We continue to make progress on the quality of our portfolio. As we have said before, we're working towards building a really strong market-leading capital-light and cash-generative bathroom portfolio. And probably the highlight of these results is the record operating profit in our core UK and Ireland markets, that accounts for 90% of our group profit, with UK and Ireland operating margin exceeding 15% for the first time. So over the year, we've built strong momentum in terms of the implementation of our strategy, including our focus on a more profitable and capital-light business. And as we work through this short presentation, we will again demonstrate our ability to perform through the cycle and our continued focus on growing and strengthening our position as the UK and Ireland's largest bathroom brand products business. In terms of the highlights slide, a few key takeouts here. We grew revenue on a like-for-like basis, with revenue up 0.9%. This is against a market that went backwards. Our view is that the market was down anywhere between 5 and 10%. Reported revenue was lower, reflecting the successful completion of the sale of the Johnson Tiles UK business in the year, and that was in line with our strategic objectives, where we have been moving away from more capital-intensive business units. Our group operating margin was up 0.7% to 11.7%. Our cash conversion remained high at 84%, and although marginally short of our 90% target, if you have a look at our cash generation over the last years, we've averaged over 100%. And I was also pleased to be able to report that our ROCE increased 0.9 percentage points to 17.3%. Looking forward, we have a really strong balance sheet that can support our strategic initiatives, and we are confident of continued progress towards our published medium-term targets in the year ahead. We could flick slides, please, Andy. There we go, thank you. Looking at the two regions, as I said before, an exceptional performance in our core UK and Ireland markets, with a record underlying operating profit and great movement on the operating margin line, moving from 13.6% the year before to 15.5%. Strong organic growth, and that strong organic growth being driven by our traditional levers of new product development and cross-selling, and supported really by exceptional service levels. Our operational excellence projects continue to deliver, and what that means is we're selling more, and we're selling more profitable products more efficiently. And really pleased with the progress, and more to come there. And the highlight right at the beginning of the year was being awarded the King's Award for Enterprise for Sustainable Development. As you know, big focus for us is making a positive difference in everything we do. We believe that our sustainability credentials give us a strong strategic advantage against a number of our peers. In South Africa, a resilient performance in a tougher market. Interest rates remain high. If you've got a mortgage in SA, you are paying double-digit interest rates. Our NPD and service levels drove a record performance in our adhesive business, but a very tough time for our Johnson Tiles manufacturing business, with a new competitor coming online in Mozambique, bringing additional capacity to an already oversupplied market. And as we've published, we are in the process of completing a strategic review of that business. Looking forward in South Africa, we think that any recovery will be moderate. We need to get interest rates down in South Africa and consumer confidence back up again. Thanks, Andy. If you could flick again. I think something that we just want to point out, some of you might be new on this call, and some have been on these calls before. But what really differentiates Norcros is that we are the largest bathroom products group in the UK and Ireland. And with the scale comes a number of benefits and a number of things that really differentiate what we can do versus a number of our smaller competitors. And it would be quite unusual for a business to start off with the strength of our balance sheet, but we have a tremendously strong balance sheet, and that allows us to strategically do the things that we want to do, be it through organic growth, investment in operational excellence, but almost more importantly at the moment, it's the surety of supply. And we win a lot of business now where big B2B businesses, new house builders are looking for partners who are not only relevant in terms of product and style, but also their ability to keep their promises. We actively invest in inventory, and we have a very, very resolute and strong supply chain. That means we are able to keep our promises and indeed our customers' promises. Our strength and size also allows us to do different things in terms of new product development, technology. We have greater depth in talent, and as you might have seen over the last year, if you've had a look at our deck, we are able to do things from a supply chain perspective that many of our competitors can't. Thanks, Andy. And that really leads into our investment case as the UK and Ireland's #1 bathroom products group. The things that differentiate us is we are design-led and have a strong, sustainable product underpin. So all of our businesses have very strong in-house design teams. That means that we are ahead of the curve in design and quick to market. We are not a distributor. We don't sell other people's products. We benefit from scale, and that drives our organic growth. And we'll talk about cross-selling and new product development in a little bit more detail later, and also allows us to leverage that scale in terms of our operational prowess. We have a really resilient model that is focused on the mid-premium market segment. And when you look at the performance of Norcros over the last 10 years, where we continue to perform through the cycle, a lot of that is to do with the fact that we sell branded products, not commodities, and we sell those branded products into the mid-premium market that remains resilient. We've got a proven track record over the last 10 years. We continue to make progress towards our medium-term targets, and the opportunities ahead of us are significant. We have about a 10% share in the UK and Ireland in a very fragmented market. We are the #1 and are able to selectively grow both organically and non-organically in the segments and categories that we want to. Thank you, Andy. If you could click across, and I'll hand over to James.
Nice. Andy, if you could take us to slide number 8, please, and some of the key financial takeaways. Firstly, UK and Ireland operating margin was 15.5%, and that's a record performance. We are proposing a total dividend for the year of 10.4 pence. That's up 0.2 pence on the prior year. We've reached a great result on the pension. Company cash contributions of circa 4.5 million per annum will end in the next 24 months. Our cash conversion remains strong at 84%. And as Thomas mentioned, we've almost completed our strategic review of Johnson Tiles South Africa. We maintained our low leverage at circa 0.8 times EBITDA. And we also now confirm our capital allocation framework in these results. So if you take us to the next slide, please, Andy, and the income statement. Total revenues were 368.1 million. That was up 0.9% on a constant currency, like-for-like basis against the prior year. And in turn, reported underlying operating profit was 43.2 million, and that was in line with the prior year. And pleasingly, the group reported a return on sales that increased to 11.7%. The finance charges were 6.7 million in the period, in line with the prior year. Exceptional items of 7.7 million mainly comprised of restructuring costs in relation to the depot consolidation at Grant Westfield and the warehouse consolidation at Vardo. Acquisition and disposal related costs of 25.4 million mainly consisted of the non-cash loss on disposal associated with the sale of Johnson Towers UK, and that completed in May 2024. So you take us to the next slide, please, Andy, and just some of the bridges. I'll be very brief on this slide. Looking particularly at the underlying operating profit charts on the right, top right, underlying operating profit was in line with the prior year at 43.2 million, with a strong UK performance, a 1.5 million increase, offset by South Africa. Finally, looking at the bottom right chart, underlying operating profit in the UK was a record 39.8 million, and the return on sales increasing to 15.5%, and that reflects our investments in new product development, operational efficiency, and the sale of Johnson Towers UK. So if we move on to the next slide, on slide 11, it's going to pick up diluted underlying earnings per share was 32.4 pence. That's up 0.3 pence. And turning to the dividend, we're pleased to announce that the board is proposing a final dividend of 6.9 pence per share, bringing the total dividend for the year to 10.4 pence per share. And this reflects the board's confidence in the business, the group's growth strategy, and other key stakeholders' future cash generation and earnings growth. If we go on to slide 12, we have a look at the cash flow. An underlying operating cash flow of 38.9 million in the period, and a solid conversion rate of 84%. And as Thomas mentioned, this is in excess of 100% when conversion when looked at over the 2-year period. Going on to the balance sheet on slide 13. I think what we want to draw out here is net debt at the year was 36.8 million. And importantly, with leverage at 0.8 times EBITDA, the balance sheet remains strong and in really good shape. And I think we have continued to have significant liquidity and funding headroom to invest in our strategic initiatives, which I'm sure Thomas will tell you about very shortly. On to slide 14, I think that's the detail on the triennial pension valuation from 2024. Really a watershed moment for the group, and the group's deficit repair contributions of circa 4.5 million per annum, they will end within 24 months. The actuarial deficit of 11.7 million is expected to be fully funded in that time frame, and if earlier than that, the contributions will then be directed into escrow. And overall, this is a tremendous result for the group. Finally, on slide number 10, slide number 15, we set out and confirm our capital allocation framework. Our capital allocation priorities being 1, organic investment, 2, ordinary dividends, 3, complementary acquisitions, and then finally, supplementary distributions. And this will all be done within the guardrails of maintaining leverage of below 2 times, dividend cover of approximately 3 times, and this will be alongside our strategic targets with a cash conversion in excess of 90% and moving towards a ROCE of 20% in the medium term. Thomas, back to you.
Thanks, James. And if you could click through to the next slide, please. As laid out in our capital markets deck, our strategic plan is divided into 4 key initiatives, and the first is portfolio development. And we've made really excellent progress over the last 2 years, reshaping our portfolio into a capital-light, cash-generative and leading bathroom business. And we have really strong opportunities to accelerate our growth, both organically and through carefully managed and targeted M&A. I will take you through some organic growth examples shortly, as I will also on the operational excellence. On the 4th point, ESG, it's something that we don't talk about enough, and kind of got this broad brush their way through, but we see this as a very, very important strategic enabler and differentiator. And I'm pleased to announce that we're on track to deliver our 2028 SBTi targets. We'll do that ahead of schedule. We have just launched a Norcros Sustainable Products Framework, and that's really about being open and showing which of our products match certain criteria. That's not only for our B2B customer base, but also making it easier for end consumers to make better choices And as I mentioned earlier, we are being recognized for our excellent work in this area. Thank you. Go to the next slide, please. This is a famous old slide that we've done up and put back into our deck. And this really talks to two things for us. We already have a very, very strong bathroom portfolio with leading brands like Triton, Merlin, Croidex, Grant Westfield. Some of you might not know that well, Tel in South Africa. But when you look at the middle, there's a lot more to go at. And the real strength of our business model is we can enter and get into those additional categories either organically, as we have this year in Vardo, where we have launched into the furniture and sanitary ware segments through the launch of our Cameo range, or we could do it through acquisition, and we have an excellent track record from an acquisition perspective. Looking forward, in terms of our portfolio development, we'll continue to consolidate what are large and fragmented markets. We have a very disciplined approach to this, and by following this approach, you've seen what we've been able to do in terms of the performance of our business, the quality of our portfolio, and that's best illustrated by the progress you're seeing in our operating margins and return on capital employed. Thanks, Andy. Just giving an example of some of the things we do to drive organic growth ahead of the market, and our target is always to grow 2 to 3% ahead of the market. The bathroom market is split essentially 20% new build and 80% RMI, and RMI in itself is not just one big lumpy number. It's broken up into different segments. You've got the light side of RMI, heavy side of RMI, and fortunately for us, our products are branded products. They are light side products, and they're all targeted to the mid-premium segment of the RMI market. But when we can't enter a new segment through M&A, we have the ability to do this organically. And last year, through Vardo, we launched the Cameo full bathroom range, which included furniture and sanitary ware for the first time. Now, the furniture and sanitary ware markets together in the UK and Ireland are worth just less than £1 billion per annum. So a lot to go at. Cameo has performed extremely well, albeit that we've only limited it at this stage to the independent market. It has exceeded our expectations and the targets we set ourselves. And quite early on in the progress of the Cameo range and performance, we pulled the trigger to accelerate the rollout of our bathroom ranges, with Safari having recently been launched at the Clerkenwell Design Week about 2 weeks ago. And you can see a picture on the right-hand side. The launch of this full bathroom range includes strong collaboration between Vardo, Merlin, and Grant Westfield. And again, we have strong sustainability credentials in this range with water and energy saving features, with the timber coming from certified forests and our packaging being 100% recycled. I think the other really interesting thing and important thing here is, when we talk about sustainability, we've been working really, really hard in terms of reducing our footprint as we move stock around and working really closely with Maersk. We shipped in the last year our first shipments of product on eco-fuel ships that have an 85% lower carbon footprint when you ship. So when we do import products, we're doing it more responsibly and with less impact. And in the year ahead, we will be shipping circa 20% of all of our freight using this new fuel, which is very, very helpful and with a lot of support from our shipping lines. Thanks, Andy. If you could click on. The second key driver, so obviously we've got new product development driving ahead of market organic growth. The second key driver is leveraging our scale and helping each other to sell across the brands and into each other's key customers. This slide was put up at our Capital Markets Day. It shows our top 20 customers along the bottom and our UK and Irish brands up on the right-hand side. And through a structured approach to targeting where we had gaps, we've made considerable progress. This is about 2.5 years of work starting to come to fruition. The first thing to note is that obviously Abode is a kitchen business, so we wouldn't have a huge amount of cross-selling there. But the obvious things that we would do here is Vardo, which traditionally sold only to independents and house builders, has been introduced to a number of Merlin's customers in the other channels, including retail and trade, and a number of good account wins in our top 20 for Vardo. Those are in the main quite immature at this stage and would take about 3 years to grow to maturity, but good early progress made there. On the Grant Westfield side, when we buy businesses that we believe we can grow. And as we did with Merlin, which we doubled in size over about 6 years without diluting our operating margins, we are now doing the same with Grant Westfield. And Grant Westfield has been introduced to 5 of our top 20 customers. We've published 3 of those at the half year. They've been Screwfix, Wicks, and Tops. And another 2 landed in H2, driving really strong growth for Grant Westfield. So although there are a lot of ticks, you can see it's a structured approach. We don't take on too much at a time. And the most exciting part of this is really that most of those ticks are quite immature and have a lot of growth left in them. We still have some gaps, and we continue to work towards plugging those gaps. We have a similar approach in national and regional house build, where we have leading market positions with the leading players in both national and regional. So strong new product development, strong cross-selling, driving ahead of market organic growth. Thanks, Andy. Next slide. Spoken about operational excellence, and this is really about selling more and selling more efficiently. And both of these 2 major projects, which saw our UK footprint reduced from 26 to 15 warehouses in FY25, were not driven by cost. They were driven by how do we support our customers better, and any cost benefits we got would be a bonus. And really, really pleased with the work done here. The Vardo consolidation at Bridgewater was completed in April 24. We've moved out of 6 warehouses and down to 2, with one of those warehouses being in Dublin now. We've seen improved OTIF, but what we managed to do was stop moving stock between warehouses. So we moved stock around less, and we were also able to introduce the new bathroom wear ranges, essentially on the same cost base. So the new warehouse cost no more than the old warehouses combined. We are in the process of launching our semi-automated picking line at Vardo, and I look forward to reporting back on that when we talk to you guys at the half. Grant Westfield, we bought that business, and much like Merlin, have had a look at how best we could grow it faster. And part of growing that business faster was improving the service offer. Very strong young team at Grant Westfield identified significant benefits in our Merlin model. And essentially what we did is we moved out of a depot model that took us 5 to 7 days to move stock around, and again, handling stock on more than once, to moving the stock into a single warehouse with Merlin in the Midlands. What we have seen there is a significantly improved OTIF, and we've halved the lead time. So order to delivery is improved by 46%. And essentially, we can move panels anywhere in the UK in 48 hours. Not that we need to do that all the time. So really, really pleased in terms of driving up our service offer and doing that more efficiently. And that's what you can do when you've got the size that we have and the collaborative culture that we have. Thanks, Andy. Just a quick slide talking to the project with Maersk. Firstly, talking to our SBTI targets. That was really a 33.6% reduction off our base year in FY23. We set that target to get there by 2028, and as I said, we'll get there well ahead of that. But really, at the end of the day, this is just common sense. Sustainability isn't pie in the sky stuff. It's common sense. It's doing the right things, and finding like-minded partners like Maersk, where we've spent close on 2 years cultivating a relationship, testing concepts. And what our size allows us to do is deal directly with large shippers like Maersk. A lot of our smaller competitors can't do this. Maersk have strong ambitions in the sustainability area. So do we. We were on the first ship coming across with the new eco fuels in FY25, and as I've said, in the year ahead, we should be shipping around 20% of everything we ship out of China on these ships. So very, very excited about this, and it's just another practical way of making a positive difference, and we're doing this on an increasing basis. Thanks, Andy. Our people is really what sets us apart. We run a decentralized model, and our best people are out in our divisions. There are 14 of us at the center, mainly accountants. I'm probably one of the few non-accountants here. But our job here is really to support, to challenge, to fund, and to really help what are the best teams out in the market, drive growth profitably and responsibly. We have a common cause across our businesses, and that is really distilled in our purpose, which is to create products and connections that offer sustainable choices for better living. You will notice it doesn't say force you to buy sustainable products, but we want to make sure that people have responsible and powerful choices. We have our values and our keys, which again talk to our low ego and caring but focused approach, and that really wraps up into our employee proposition, which is about being someone. Regardless of who you are at Norcros, you can be someone, you can impact, and you are important, whether you are quiet or noisy. We spent 2 years on this as well, but in the second half of this year, launched the Be Someone campaign. James and I and a number of executives traveled and spoke to every single one of our employees in the UK and Ireland. And that's really borne out by 81% of our employees who say they are proud to work for Norcros. So that's not people who are neutral or negative. That is people who are actively proud to work for Norcros. So a really important part of who Norcros is. Thanks, Andy. So as you can see, we have a number of our growth accelerators in play. We have a successful and scalable platform built around market-leading brands, diversified products and channels. We are design and service-led, and we have a proud organic growth and M&A growth track record. There's significant opportunity to grow in large fragmented markets. We're going to grow by focusing on sustainable products. We will increasingly be looking at adaptive living or care products. We've got aging populations who need help to live in their houses for longer and take pressure off the government. And we're starting to make some progress there, and we'll continue to leverage the benefits of our scale. I've spoken about our 4 strategic pillars on the right-hand side, and those are all in play. And I'm really pleased about the progress we're making towards the medium-term targets that we did publish, and those are covered across the bottom of this slide. Thanks, Andy. So in summary, if you could go again, Andy. We've had a cracking year. Year to date, to the end of May 25, revenue did drop a little, being 1.8% below year on year on a like-for-like basis. Don't want to get into too much, but I don't think anybody needs to read too much into the April and early May comparisons with how the holidays fell. Apologies. Over the last 4 weeks, our like-for-like revenue growth has returned to just above 2 to 2.5%, with both regions reporting like-for-like growth. So trading well and comfortable about the numbers that we have in the market for the year going forward. We will continue to make progress on our strategic initiatives. And as I've said, we have a really successful, differentiated and scalable platform in large and fragmented markets. I just want to be clear that we do not need a recovery in the market to achieve the numbers that we've published in the year ahead. And any recovery, for instance, in household, albeit that we're on the back end of the household cycle, would be of benefit to us. So the board's expectations for FY26 remain unchanged, and we are confident in terms of delivering those. So thank you for listening to that. I hope you found that helpful and interesting, and we are open to questions.
We've got quite a lot of questions already. Keep coming. Let's follow on from what you were ending on there, Thomas. You're making steady progress towards your medium-term targets. So we have a question What regional mix in terms of businesses do you anticipate in a few years' time that would help support sustainable 15% group EBIT margin? And I suppose that is a subtle way of saying, would it be conceivable that you would add on a new region alongside GB and South Africa?
Yeah, so I mean, if you're looking back to the Capital Markets Day, we spelt out where we saw a regional growth coming from, and that would really be we keep growing our core markets, but we'd be looking at Europe and the Gulf as adjacent markets. We don't really foresee heading to South America or to the east. We are already trading in Europe and the Gulf, and so those would be natural areas for us to grow into going forward. Any sort of entry there that is M&A driven would reflect our strategic targets. So we are going to be capital light. We're looking for high growth segments and high growth categories, and that would really drive and deliver that program.
And common sense will prevail.
Yeah, correct.
Yeah, well, always a good way to run a business. Right. I'm sure there are sensitivities here. So just a general question on the JTSA strategic review, which is, might shareholders expect a decision in weeks or months?
Yeah, I think in weeks. We've been manufacturing in South Africa since 1954. We have had an oversupplied market there for some time now. We have built significant inventory, and while this has been going on, we've had a massive new competitor arrive in Mozambique to supply an already oversupplied market. Given that we've built a significant amount of stock and consumed a significant amount of cash, we've had to kick off this review and have a look at what our options might be, and we'd be in a position probably in a couple of weeks to announce what that would be, and we'll do that publicly.
Right, thank you. Perhaps one or two for you here, James. We have a statement which I can't argue with. Geopolitical shocks seem to be occurring all too regularly. Agreed. So a couple of questions from this viewer. Firstly, on inventory, are you likely to keep holding more inventory than in the more recent past to keep key supplies going for your major clients?
Yeah, it's a really good question. I think that comes back to the benefits of scale that Thomas mentioned at the start of the presentation. We've got the balance sheet to invest in inventory, and it's a deliberate decision to do that. We think strategically that really helps our customers' supply chains. And I think with all the geopolitical uncertainty or volatility, I think resilience of supply chains has just become increasingly important to many businesses across the globe. And I think what we can do at Norcros is help them manage that volatility by holding inventory and managing supply chains, not least through our 30 people in China.
Yeah, and perhaps to follow on, looking at the Middle Eastern situation, we have a question. Could you just update us on how tariff issues, however they end up, might affect you, and also moving to the Middle East, shipping costs? How much can you protect yourself into the future against the volatility of costs in that market?
I'll pick this one up. It's so I mean, the first thing to look at is we do very, very insignificant business in the States, so we don't send a huge amount of product across the States. The main freight issues have really been the lines and the shipping routes to the States since Liberation Day, or just before so-called Liberation Day. The indirect impacts, people might argue, would be Chinese companies wanting to redirect a lot of their production to Europe and other places. I don't see that as being a sustainable alternative. I think what you'll find is that we've already seen it, the Chinese government stimulating demand, and in the short term, weaker Chinese businesses maybe not make it, and the stronger ones surviving. I don't think they're able to drop their prices by 20% and hold that for any period of time. in terms of the stability of supply, and this comes back to our size and our relationship with our main shipping partner, is that we are able to secure containers. We are able to lock our pricing, long term, and we do that, and that gives us great protection at times like this. And if you think of, for instance, in the new house build partnership building model, where the house builders are having to fix prices and then build into that, our ability to hold inventory and then manage our shipping costs, our predictability of supply, means that we're in a really strong place to be able to support house builders in an area like that. But that works across our business. So who knows what's going to happen next, but I think we've got a proven track record of managing our way through this. If you're a smaller business, you're not able to do this, I can tell you right now that shipping pricing is increasing. If you're buying spot, availability of containers is also becoming harder, and the ports are getting out of balance to a larger extent. So we're very, very well positioned to actually do well at a time of difficulty, which we normally do because we can keep our promises.
Yep. Well, that's a perfect segue into the second part of the supply chain question, which was, you've been winning clients. Can you share any examples of Norcros companies winning clients specifically because of the group's robust balance sheet and Norcros's long record of keeping promises to clients?
Yeah, so I'll be careful here because it's obviously commercially sensitive, but I'm sure they won't mind because we do call them out. We do really well with a company like Wix, who understand not only that we have a strong balance sheet, but that we have a very strong partnership model. We work closely with them. We feel it's our job to help them stay on trend and relevant and ahead of the market. And so we do extremely well with them, and the considerations around balance sheet, the considerations around our ability to supply ESG data, and the considerations in terms of keeping their promises for them would be a really good example of that. We have recently won a number of really important new house build accounts, specifically for the reason that I shared just ahead of this as well. So I think we have a really compelling and differentiated offer, and our numbers tell the story, quite frankly. Yeah.
Great. Well, you mentioned house builders, so we have a question here. A number of UK house builders have been giving out much more positive messages about new build. And whilst recognizing, as you mentioned, that you're more the end fit out stage, are you seeing any signs of encouragement coming from your clients in house building space regarding new build?
Yeah, we are. I think it's going to be a sort of a non-linear sort of bit of a splatter initially. We will build more houses this year in the UK. I think if you just look back across the new build cycle, you've seen sort of probably 9-12 months out, the infrastructure stock starting to do a bit better, and demand for aggregates that's moved into bricks. When there's more bricks, that's indicative of new house build. I do believe that we could do a little bit of help on the interest rates, and certainly the government could stimulate this a little bit more by helping first-time buyers or something similar to accelerate this process. But I do think we'll see more houses. It's just at what rate that comes back at, and we have leading positions in the new house build market nationally and regionally, so we'll benefit from that, and that's another good part of our model. We do well in RMI and house build, so it's a bit of a compounder for us.
And of course, RMI will never disappear, though, regardless of the growth in new build. So
every time someone moves into a new house, somebody buys the old one and renovates the bathroom. So it's helpful.
Yeah. Now, property, maybe for you, James. The benefits of warehouse consolidation have been illustrated. So we have a question: is there more scope for warehouse consolidation? And linked to that, are there any group properties that can be realised for cash as part of this rationalisation?
I'm going to elegantly pass that one to Thomas, because I know it's a big big thing of his talking about the Grant Westfield consolidation and improvement in KPIs. So, Thomas, I'll hand that to you.
Happy to
Knows
do
how
that.
important the question is there.
Well, no, look, we talk about it all the time. We've done the heavy lifting in the UK in terms of the footprint, and what we'll do sensibly going forward is I do see that footprint reducing. We will do it as leases come to an end. I can't at this stage categorically say we'll have X number of warehouses. It'll be less than we have today, and we'll just do it as part of normal business as we progress. It is our policy not to own properties that we're not trading out of. And I think by way of example, we did sell half of the Johnson's property in this year and would be looking to offload the other half in the year ahead. So when the opportunities come to get out of properties that we own that we're not using, we would always look to sell them.
Well, I'm determined to get one for James. So let's talk about capital allocation here. So M&A has been successful for the group. You do have, understandably and very wisely, limitations on the prices you're prepared to pay. If M&A deals can't be executed on pricing grounds in the next year, would the board consider special distributions or share buybacks, or are you just going to wait till you get there and your preferred strategy at the moment is to find the right deals to do?
Yeah, let me start by saying, first of all, our M&A pipeline continues to be well developed and is active. We've got a number of really exciting opportunities. Some of those opportunities might be from an initial information memorandum, some might be in exclusivity, some might be in due diligence. And I think the thing to say would be we're very thorough with our due diligence, and we're always prepared to walk away from a transaction if the risk can't be mitigated. I think to the specific question of supplementary distributions, I think we would be disappointed if we didn't execute on M&A in the next 6 to 12 months, and it may even be sooner than that. But as everyone knows, when it comes to deals, there's sometimes they go very, very quickly when you don't expect them to, and sometimes they go very, very slowly when you think they might be have a little bit of speed behind them. But we're looking at some really interesting opportunities in the UK, Ireland, and near shore Europe, and we would expect the sweet spot for those deals to be 30, 40, 50 million of all debt.
Great, very clear. Thank you. The jigsaw slide has been well received on its return, and loosely paraphrasing this question, you've mentioned the opportunity and indeed the success of organically filling in the product category maps with Vardo and furniture. How likely is it in a year's time that we'll see another piece of the jigsaw solved by organic development of categories?
Likely would be the answer. So, I mean, I'll be totally open, transparent on this one. It's not that difficult. So, as we do a complete bathroom, and we've launched two ranges, for instance, on the second range, Safari, we've introduced some specific and matched lighting. So it's very small, but there we go. We're in lighting now. You could think of the next piece to be added is the baths, things like decorative radiators. We don't have to do M&A to go into those spaces. So, as we design these bathroom ranges where it makes sense, and you talk about common sense, which is our fourth value, we will naturally do that.
Yeah, again,
sure.
Makes perfect sense. Thank you.
Yeah.
Vardo has been doing very well. It seems to have won a lot of the new listings with your major customers. So we have a question, as much as you can enter internal information. How big is Vardo now, and what does it have the capacity to scale up to, in your opinion?
I think it has the capacity to scale significantly. So just remembering a lot of those new customer wins are quite immature at this stage. They are early doors. So for instance, if we got Cameo furniture range into a retailer, That's a single range. We need to prove it. We need to wait for a range review to get the second range safari in. But essentially what's happened is Vado struggled for a while, because if you look at the two sectors that were most hit by the economy, it was independent retail and new house build, and those were the two channels they operated in. So we've landed these new accounts, and we continue to do it. We've also expanded the product category from taps to bathrooms. We're at early maturity, and like Norcros does, we just slowly chip away, and it'll gain momentum as it goes. But Vado has made progress in the year, and good to see that. Excellent execution of both that operational excellence project and the work around new product development by the team there has been really outstanding. So that's like planting a good seed. It's starting to sprout, and the growth will just become more apparent as we move forward.
Good to hear. Now, an important one here, which I'm glad you can try and answer, because it's not factually demonstrable, but you've mentioned cross-selling as a major objective. You've mentioned occasions where it's been successful. Could you say a little bit more about how employees and divisional leaders are incentivized, or how you have brought about, or how the group has brought about such a collaborative culture over the many years, which is now paying dividends?
I've been with the group since 2006, and I think there's always been this decentralized model where, as teams and team members, we've been given latitude to use our brains and operate, and received a huge amount of support. Now, as the group has grown, when I joined, there were 3 businesses. As we've grown, we kind of reached a scale where there was a much more natural discussion to be had in and around how do we do more together? How do we make the sum of the parts more? And that probably followed the Merlin acquisition. So we already had good cultures across our different businesses. We then have formal forums. The most senior of those be the Managing Directors Forum, where we share ideas and we decide, this is something to work on together or not to work on together. That flows down into our marketing forum, our HR forums. But what we did in this year was to distill all of that. We didn't make it up, and come up with this overarching Be Someone initiative that talks to the fact that we trust our staff to do the right thing. We want them to grow. We want them to impact. It's hugely powerful, and will continue to grow. So it's a passion of mine. I could speak for an hour or 2 hours on it. But if you follow us on LinkedIn, you'll see a number of the road shows there. We're going to be posting further progress on that. And that collective, low ego, non-transactional way that we work with each other really sets us apart. It's a wonderful place to work.
Yeah, well, I'm fortunate. I have seen it firsthand at your Capital Markets Day, the divisional heads sharing ideas, traveling the world to move things forward, which is great to see.
Yeah.
And just time, I think, for a last question, which again, this is a subjective one. You have some core initiatives. Which one most excites you as regards prospects for the new and current financial year?
Sure, that's a tough one. I think what I would say is that we have really strong brands and market positions. We have a leading market share that is only 10% of the current UK and Irish markets. We are market leaders in the fastest growing areas, and we have teams that are aligned with very strong new product development pipelines. And I think that combination of leveraging our scale and continuing to deliver outstanding product with strong sustainability credentials just keeps us relevant and ahead of the curve. So I think it's just continuing to do what we're doing at an accelerated rate. And given that we've done a lot of the heavy lifting in terms of offloading and dealing with some of the stickier parts of our business, we're a bit more light. We can move a little bit more agility. We've got a great balance sheet. So the optionality we have now means that that we've got a good number of options we can go after. And you've seen we focused, we publish what we're doing, we stuck to the plan, and we have the teams, and that's ultimately, we really do have the teams that can deliver this, and that's what I'm most excited about in one sentence, is our teams.
Yeah, and Andy, just to add on to that, I think it's a great question, because we've got a lot of things in the hopper. They're really interesting, really exciting, and as Thomas said, we've got some great people to try and implement them as well, whether that's product or operations or M&A. It's just a really exciting place to be at the moment with momentum.
Right. Well, a very good note on which to finish. Thank you very much for not just the presentation, the transparency of the answers to the questions. Thank you to the audience for putting them in, and in return, you will get a feedback form, which the management would be very keen to get your thoughts on. If you want to know, what this all means for prospects for Norcros shares, there is an equity development note out this week with a materially increased fair value assessment for the shares. So fingers crossed, gentlemen. Thank you for your time, and I hope the good work and the success continues in FY26.
Thanks so much, Andy, and thank you
Thanks,
to
Andy.
everybody.